Well, lots of inflation news this week. Did it help us? Did it hurt us? That's what we're going to talk about, y'all. Today is the 15th of May, Thursday. Hope everyone is doing well. As mentioned, CPI this week, producer price index this week, both better than expected, y'all. CPI came in a tenth better than expected. Producer price index came in 0.3 better than expected. And that's after some serious revisions to the prior month's reporting, y'all, for PPI. Ordinarily, good results on those two reports would have given us a nice bid in the bond market. We would have seen rates coming down in the face of people buying fixed income securities on that news. We're not seeing that. We're seeing a little bit of improvement today, but not what you would expect given the really, really favorable read from the PPI report that we got today. Part of that, y'all, is the Dow Jones is loving the trade deals that seem to be materializing out of the threat of these tariffs. We've got big deals inked with the Great Britain. We've got deals that are in the process and looking very favorable with China, a 90-day reprieve on the severe portion of their tariffs as those deals are being negotiated. The Dow loves that. Stock market and equities are rallying strongly. In fact, over the last 3 weeks, the Dow Jones up 3,000 points, y'all. We have recouped, at least in the S&P and the NASDAQ, I believe all of the weakness that we saw from the tariffs first being announced. The Dow is almost there with regard to where we were. So interesting to see how equities have recovered, and they've done so to some degree at the expense of the bond market, and that has not helped interest rates. Remember that supply and demand reigns supreme across all markets, including the fixed income market. And when folks are motivated to buy bonds, the prices go up and the yields come down. Those yields are our rates. The inverse is also true. If everyone is sticking their money in the stock market as they currently are in the face of these rallies, they're pulling a lot of those funds. These are a lot of the same investors, and that's giving us some weakness in the bond market. Bond market wants those dollars back, and as a result, prices fall, yields rise, right? And those yields are, again, our rates. So that's what we are seeing play out on a very big stage. Let's get into the numbers. If I didn't mention it earlier, Mortgage News Daily has a 30-year fixed rate conforming loan at 6.96 for the national average. We were at 6.91 a week ago. We were at 6.88 a month ago, y'all. So we're up about an eighth over the last, well, not quite an eighth over the last 30 days or so. In any event, I'm going to be watching it. You know, I always do. I geek out over these numbers. Happy to put all of this expertise to work for you and for your clients, give them the best possible advice so they can properly time their lock-in. In any event, hope this is helpful. You got my contact information on the screen. Stay blessed, stay safe, and we'll talk to you next week.